I will try to give in this half an hour a bit of a flavor of what value-based investing is in from Europe today. Interesting times, obviously. I will give a couple of examples of the investment cases which are in our top 5 positions in the portfolio. And first of all, a bit of an overview on our portfolio as of today. Okay, well, here it goes. So this is what we have been able to build as of today in as a portfolio, right? As a global portfolio. 6.8 times earnings, 28% return on capital. So it doesn't look like value investing means just value traps. And if we take out the commodity side of the portfolio, which is relevant because we are invested in oil and some other shipping stocks, we have a 44% return on capital on the balance. So in the 70% of the portfolio that is not commodity oriented. So high quality stocks, I would say. Free cash flow yield is 20% because a lot of them are net cash. So actually the yield is really high and the leverage is very high with a lot of upside. Obviously, if you're trading at 7 times earnings, the upside is very, very big. If they are good businesses, the upside is quite significant, right? The family owned, most of them, 65 2/3 have families or control groups, which is quite usual in Europe. And 62% of the portfolio is in European-based companies. Obviously, the sales of the business are spread all over the world, but you tend to focus in companies quite near to you to have a better grasp of what's going on. On the right side, you have the main blocks of what we are doing, which is long LNG. We are very focused on LNG. And some other shipping stocks, a bit in Italy, a bit in the UK. Out of fashion means UK, 11%. Some commodities, some automotive, restructuring, shipping. This is roughly the flavor of the portfolio. Actually, I mean, I'm really happy with the portfolio. I mean, finding this kind of numbers is very attractive. Besides, as we all know, in the last 2-3 years, value stocks have not performed very well. So something that was attractive is even more attractive today. And we will see with a couple of examples that I'm going to introduce to you that this kind of unbalanced market shouldn't last long because actually the value is so compelling that someone will arbitrage this kind of gap that is in the market at this stage. That it reminds me absolutely like a clone in 2000 and the previous kind of bifurcated market that we had 20 years ago. I mean, it's pretty much the same thing. Remember, everyone has to remember that after that market, value had something like 70-75% outperformance vis-a-vis growth stocks or the market in the following 3 years. Right? So the first example that we have, it's a large holding for us, is Dixons warehouse. It is the leading electronic and appliance distribution in 6 countries in Europe. I mean, it is the best value of these 6 countries for those of you based in the US. 100% return on capital. It's quite a good business and has been able to compete with Amazon as most of the electronic and appliances distribution companies have been able to do. Because as we all know, 80% of the clients want to touch the product and go to the shop. So to have a combination of online and physical stores is the key factor here. And we have here how Best Buy has performed in the last 5 years. We have to say that in the last 12, 13 years has been even worse because we used to be shareholders in Best Buy when the company was trading at $10, $15. Now it's trading at $120 as of today, all-time highs. So at that time, there was a risk of Amazon eating the pie. It looks like that is not the case anymore in electronics and appliances. And look what Dixons have done. Dixons stock has done in the last 5 years. So meanwhile, Best Buy has tripled. Dixons stock has been cut down more than 50%. So that has created a very, very attractive opportunity from our side. And here there is another compelling comparison with AO World, which is the pure online market leader in the UK. But as you can see in the last half a year that we have results after the pandemic started, we see that purely in the UK, Dixons is clearly the leader, has increased in sales more than the sales of AO World in size in the UK is now. So it is just amazing the growth that the Dixons has had in the UK and in all the markets in which they are present in the 6 markets. As of today, the sales in the first half were something like 1.8 billion pounds in pure online business, and probably will end up the fiscal year with 3.4 billion in online business, meaning that it is a very significant online competitor, both in the UK and in the 6 markets they are present, which are the 4 Nordic markets and Greece. In all of the markets, clear market leader, both in online and offline. Well, which is our valuation? Well, we use 17 times earnings. We think it's a good business. We think it's almost impossible to replicate what they have in those 6 countries. We have a normalized free cash flow for 2022-23, well, depending on the year, because they are closing down the mobile business. So there is some tailings in losses, probably in this fiscal year, this coming out. But roughly, this is the consensus number. So, well, you can use 17 if you want. We use 17. Best Buy is trading at 15 times. AO World and more than that. You can see the market cap, which is 1.7 billion. You know, it's not that bad. 1.7 billion for a 4 billion online business leader in 6 countries. Not that bad. Making money, by the way. And on top of that, you have a 5-6 billion physical leader also making money there also. So we don't think that it's clear an opportunity here. We don't have to think too much. We see that Best Buy in probably the most efficient market in the world is trading at 15 times earnings. We don't see any reason why this company shouldn't be trading today at 15 times earnings. What can close that gap? Well, several things we think. First, that they deliver on the strategic plan. Alex Bradford, the current CEO, came here 2 years ago, and he's been doing a very good job. I mean, he was the CEO of a very large online business previously, very successful, and he is really, I mean, he has done a very good job also here, trying to improve the online proposition and doing a lot of things. And they have something that we think is quite unique and something that is a clear barrier to entry for competitors, both for Amazon and for everyone else, and for AO World and for mom and pop shops, which is Shop Live. It's a feature that you go to the website and you can ask in 5 seconds to someone from the shops to ideas to what to buy. I mean, it's like if you were in the shop, right? And this is something that they do that with the spare time that the people, I mean, the workers in the shop have. And it's something that Amazon cannot do, AO World cannot do, because they will have to hire people. And the mom and pop shops obviously cannot go through the website. So that's been a tremendous success, and they will help and get do the margins that they want to achieve, right? Also, they are closing down the mobile business, closing down the shops, and they will make cash on that, because there was a lot of receivables given to the telco companies. The cash will come in the next 2 years. Well, currently it's already coming in, and there's losses that were probably this is the main reason for the stock price undervaluation. Shareholders have really suffered the closing down of this business in the last 2-3 years with significant losses. in these 2-3 years. That's over. Will be over in a few months. Also, we will have possibly or probably the IPO of the Nordic business at much higher multiples of the 7 times the company is trading now. They could do it or not. It will depend on markets and things, but that will create another way to crystallize the value. And also more consolidation in Europe. We think there are a lot of things that can go well for Dixons and can close that gap that is currently the stock price suffering. So that's for Dixon. And the second idea I bring to the table is Cher, which is an Italian holding company controlled by the Benedetti family. Also, this is a large holding for us, top 5 holding. The company has 3 main assets, which is Cobas, nursing homes in Italy and Germany, Sogefi, an auto parts company, filters, suspensions, and cooling systems, and Kasha non-core. So, and here I would like to go over what is growth and what is not growth, because sometimes people think that value investors and don't invest in growth-oriented companies, which is not the case at all. I mean, I said before that 20% of our portfolio is investing in LNG, and the LNG business has grown in the last 40 years, 5% in volumes per year, and is expected to grow 4 or 5% in volume per year in the next 10 years. It will be not only the transition energy in the next 30 years, but I mean, we guess it's going to be very complicated to take all the fossil fuels out of the picture, and if one is going to be left standing, would be LNG, and we don't avoid growth stocks. We at least in our company in Cobas, what we avoid is to pay up for growth stocks, and if we don't pay too much, that's very fine with us. So we have here cost with nursing homes, which we'll see it's obviously a growth business. Is the main business from Cher, is the market leader in Italy with 8,000 beds, half of them nursing homes and half of them rehabilitation centers, and 4,000 beds in Germany, right? So interesting positions in Europe. In a business with, we all know it's a good business with strong fundamentals, at least in most of Europe, also in the US. And we see the growth in demographics in this year. Obviously, there will be growth here, and it is a business not easy to enter. I mean, you need deep knowledge of the countries in which you are present, the regions in some of the countries, because it's not at an even national level, but at a local level in which decision making is made. And also you have to have a track record, reputation, and doing the things correctly, right? So with these strong fundamentals, we see that cost EBITDA evaluation in the last 10, 15 years has been impressive. We have been following Cher for the last 20 years, and we remember when we were talking with them 15 years ago, Cobas was a non-entity. There was an electric a utility company embedded in the holding that was really much more relevant at that time. And Cobas was making something like 10 million EBITDA. Well, almost with not a single capital increase in those last 15 years. The EBITDA now has a run rate of 130, 120. Well, now, as you can imagine, last year was a very difficult year for nursing homes, especially in Italy. But once they recover to a normalized, we will end up keep on growing as much as they have been doing before. So a growth business with not very large capital requirements, because in this case, Cobas only owns 20% of the real estate, so they recycle the real estate to fund for the growth. So it's not a bad business, and definitely you see here Orpea, which is the French European leader. The evolution the company has had in the last 10 years, with a significant evolution in share price and EBITDA. So clearly a growth business. And you see the multiples on the right side that show that kind of, let's say, goodness of the business. On average 24 times price earning ratios, and I think our base trading at enterprise value of something like 20 something as well. So very high multiples for high growth and very stable businesses. So they are very defensive, high growth. So what else can you ask from a company, right? So, well, the good thing on our side is that we're getting costs almost for free, which is what we like, to buy good businesses that can grow, that have a really good future in front of us, clear visibility for the next 10 years, but paying a very low multiple for that. You can see that down there, the market cap is below 600 million as of today. And the company has net cash of 350, and they have the stake in Sogefi, we think is worth between 150 million. So let's say 80% of the valuation, it's covered by cash and Sogefi. So we effectively are getting almost for nothing cost, right? So we have put here something like 20 times earnings to evaluate cost, but you can use 15, 17, 25 if you want. I mean, it's up to anyone to put a multiple. But what is obvious is that it's absolutely undervalued, the holding company, and with a very, very defensive profile, because 80% of the business, at least 60% in cash and 80% in cash, and other businesses that may be disposed of in the near future, like Sogefi, right? So why is that? Why such an undervaluation and such a simple story? And what can happen to close this gap? And again, some ideas. Actually, the family, the Benedetti family has been doing very interesting things in the last years. I mean, all of them shareholder oriented. They have simplified the structure of the holdings, emerging two holdings that were quoted, Cher and Cofide. They have been reducing the weight in Italy. They sold Jedi, we were the leading regional newspapers in Italy. And they bought Charleston, which are the nursing homes in Germany we mentioned before. So also previous to the merger of Cher and Cofide, Cher and Cofide had bought something like around 15% of the shares in the previous 3-4 years, meaning that they were shareholder friendly on that line also. Even last year, in which they were not able to buy back shares for technical reasons, the family increased the position by 1% once the share price came down because of the pandemic. And what can we expect in the near future? We can expect a further simplification, perhaps a disposal of Sogefi, perhaps a buyout in the minorities of Cobas, which is a private equity owning close to 40% of the business. And they are keen on restating the buyback, pending the approval from the AGM on April the 30th. So we do think that they will let's say end in the transformation from a holding company into a nursing home company, purely focused and trading at the multiples that the nursing home companies are trading in Europe. So that's what we expect, really. Well, these are a couple of ideas I wanted to mention. Here we have a summary of the tenets of our investment style, which I explained really in detail in investing for the long term. A book I wrote 3 years ago when I had to be on garden leave for a couple of years. So, usual value lessons, but I would say the most different from all the value investors, I would say that we're keen followers of Austrian economics, as I've mentioned several times in places, and those are the ones that understand better how how the economy works really over the long term, which is what we're interested in. And also something different from other people. As we do express, as we said in number 8 item, we recommend everyone to own assets and don't be a creditor, to limit it as possible the investment in fixed income. I mean, to lend to someone money in I mean, I would say always, but especially today, in which we are seeing a situation in which the fiat money is being discredited with continuous emission of paper, that will lead definitely sooner or later to an inflation that will kill any paper, any promise of payment in any fiat currency. I would say in any fiat currency in the world. I mean, I don't see any fiat currency that can be saved from this. It's complicated. So I personally own only assets, only shares or physical assets. I don't own, well, I limit that to the maximum fixed income and promises of payment, and that are fixed, because inflation will kill them. So that's what I wanted to say. I think I did it before my time, which is good, because it helped other people that they take longer to do this. Thanks to everyone.